Hi everyone, welcome to this time's Growing Finance. Well, last week was full of information. Inflation data came out, tariff war shows some signs of easing up, the liquidity from cutting RRR invested in bonds market. But bonds market performed weird and went north with expectation. Seems like bonds market has its own thought. So as usual, let's start with changes of last week's bond yields curve, then go deep into the details. Alright? So total bond yields curve went up and was becoming unexpected flatter compared to the week before. Yields of 3, 5, 10, and 30 years terms increased 4.4, 8, 4.4, and 3.5 base points. If we compare to the one of December 9th last year, the curve still kept twisting. 3 years term increased 12 base points. 5 years term was almost at the same position of that day. 10 and 30 years terms both went down 24 base points. The spreads between Chinese treasury bonds and commercial bank perpetual bonds kept shrinking, with 5-year spread decreased 3 base points to 44 base points. About actions of investment agencies, agriculture and commercial banks bought 170 billion long and ultra-long-term bonds, whereas securities companies and funds totally sold 130 billion. Next, let's see what happened last week and how weird bond yields curve was becoming. In terms of fundamentals, first, China and the United States made a great progress about the tariff last week in Geneva. They have made a mutual concession and both cut the irrational part of tariff. China will reduce tariffs on US goods from 125% to 10% within 19 days, whereas the United States will reduce tariffs on Chinese goods from 145% to 30% within the same period. This news gave some energy to stocks market and improved risk emotion. It also caused an adjustment of bond yields, especially long and ultra-long terms, which increased 5 to 7 base points. Then inflation data and financial data came out. About March, CPI and PPI were 0.1% and minus 2.7%, in which you can see social consumption kept stable but weak, and the supply side began to weaken as tariff issues shown its influences. For financial part, new Chinese yuan loans was 280 billion yuan, in which household loans on short terms, loans to enterprises and public institutions on middle and long terms, and loans to non-bank financial institutions decreased most. Aggregate financing to the real economy was 1.16 trillion yuan, in which net financing of government bonds was a major incremental part. So from all these views, we can see that social consumption willingness still remains low, as well as the investment intention of small and middle-sized enterprises. It is government investments that drove the data mostly. Token all, although Geneva negotiation brought some bright prospect to the economy, but the real recovery is still filled with difficulties and have a long way to get there. Thus, yields of long and ultra-long-term bonds didn't adjust much compared to the short-term end. For funding conditions, the liquidity from cutting RRR invested in bonds market on Thursday, but for somehow the funding environment was becoming tight. It's so weird, the financing price went up 5 to 10 base points to 1.6%, which led some panic in motion. The concerning about the PBOC squeezing liquidity raised again, and caused yields of short and middle-term bonds to increase. But from long point of view, China's economy is in recovery process, which faces deflation pressure from the inside and uncertainties from the outside. So I think PBOC doesn't have conditions to tighten the liquidity again, like it did in January. PBOC may just keep the financing price fluctuating with this level in short terms, but in long-run plan it may lose from the environment again. So what should we pay our attention next? First is economic data, real estate data, and import-export data to confirm the situation of the economy and the impact of tariffs. Second, the actions of two countries after Geneva negotiation. Will Trump raise tariff again? 19 days is more like a suspension period than a final resolution, so we have to keep eyes on it. Third, next week is tax season, so funding environment may tight again. About bond investment strategies, from short and middle terms view, PBOC won't take any moderately loose monetary policy further in the next few months, so there isn't any good news for short and middle term bonds. From long and ultra-long terms view, economic recovery still faces more challenges. Although bond yields curve is pretty flat, but I'm afraid flattening bond yields curve is still the most suitable strategy for nowadays. So as always, if you want to know more useful financial information about the Chinese bond market and the economic situation, please like, share, and subscribe. I will always be here, share my understanding and experience, and waiting for you. So bye guys, until next time.